Welcome back, class, to the fourth of four videos regarding Hawaii income tax preparation using this form N-11. In this video, let's take a look at calculating Hawaii tax credits. So let's jump down to page 3 where the tax credits are reported. And you can see, just like federal, Hawaii credits are divided up into two groups. One group is called refundable, where any excess credits, refundable credits, can be refunded to the taxpayer, versus the so-called non-refundable credits that can only be used to offset taxes for the current year, and possibly any unused non-refundable credits can be carried over to future years. The most common refundable credits mentioned here are calculated on Schedule X. So let's take a look at Schedule X that calculates these three credits. And let's zoom in, where the first of the three is called a food excise tax credit. Here in Hawaii, the cost of living is quite high, and to help taxpayers in the moderate or low income group, they want to partially refund the so-called sales or excise taxes paid on food purchases. Now, instead of knowing the exact amount of food purchases and the excise tax on those purchases, they kind of estimate based upon the family size and income level to determine the amount of this refundable credit that's going to be awarded. Here it says that the taxpayer's federal, not Hawaii, adjusted gross income has to be less than 50,000. So if it's 50,000 or more, then there is no food excise tax credit for the taxpayer. There's some other calculations or other qualifications for this credit. Here it mentions that you have to list down the people in your family that you're reporting on your return, taxpayer spouse if it's a joint return, also any dependents. Now, if those dependents are supported with some type of public support, welfare, then they would qualify for the full amount no matter what the income level of the taxpayer. Whereas people listed up here, the amount of the credit will go down as the income level of the taxpayer increases, which we'll see in a table from the instructions in a minute. So we would list down the taxpayers and the number, and then write down the federal adjusted gross income here in line 4. And in the instructions to the Form N-11, look up their income in this table and going across to determine how much of a credit they would get for each exemption that they're being claimed on the return. Notice that if you have a lower income, the maximum credit will go up. So if the income is under 5,000, for each dependent or exemption being claimed on the return, our taxpayer will get $85. Okay, so that would be calculated further down here. Now, if the taxpayers are filing married, filing separate, you would have to combine both spouses' incomes to get the AGI to determine now possibly a lower tax credit. Again, this is the food excise tax credit. Let's take a look at the second credit here on this Schedule X, called the Low Income Housing Credit, Household Renters Credit. So for, again, the cost of living is quite high in Hawaii. So again, we want to help lower income taxpayers. In this case, Hawaii AGI less than 30,000. Remember, the food excise credit was federal AGI of less than 50,000. And our tenant, taxpayer tenant, would list down the property that they were renting during the year and how much rent was paid, and information for the landlord, including their Hawaii general excise tax license number. Now, in theory, the state government could use this information here to make sure that the landlord is reporting the rent income on his or her tax return. Although I've never seen it happen where the landlord is audited, at least for income tax purposes. The most common type of audit in Hawaii is for excise tax or sales taxes. Now, the amount of rent paid does not determine the amount of credit claimed by our taxpayers as long as the income is less than this 30,000. Hawaii AGI is less than 30,000. For each exemption claimed on the Hawaii return, our taxpayer would get a $50 credit. This includes an exemption for age. I think I mentioned in the first of the 4 videos that if our taxpayers are age 65 or older, they don't get an additional standard deduction, but they get an additional personal exemption, which will be counted here also now for an additional renter's credit of $50. There is some adjustments where you have to report rent here, where maybe the total rent the taxpayer has to pay out of pocket during the year has to be at least $1,000. This is after possibly any public assistance like federal Section 8 um, allowances. Also, and which is not really apparent, our landlord here has to own real estate property being rented that is not exempt from real estate taxes. Not income taxes now, but real property taxes. So if the landlord is the government, possibly low income housing, this property would not qualify for the renter's credit. Or if our landlord is claiming a homeowner's exemption, meaning that the whole property is not fully subject to real estate tax, technically this property is not eligible for the renter's credit. Okay, so this is the second credit reported here on Schedule X, the low income households renter credit. Now on page 2 of this Schedule X is a similar credit that we've seen on the federal return for our Chapter 9 in our class called the Child and Dependent Care Credit. So pretty much similar as the federal rules, we need to identify the provider name, and then there's limits in terms of the dollar amount we can claim for each dependent. One is for 2,400 or two or more is 4,800. Okay, so the calculations are the same pretty much as federal, but now the rate being applied here is different. So you would go to the instructions of N-11, and based upon the taxpayer's AGI, we would find different rates. I believe the lowest rate for Hawaii would be 15%. Now, all of these 3 credits, going back here on the form N-11, are the refundable type. In other words, the good type. If our taxpayers' credits here are larger than the tax itself, the excess can be refunded back to the taxpayer. A special rule is you need to note is that these credits have to be claimed by the end of the following year. In other words, if we were looking at the tax return for 2015, to be able to claim these credits, the tax return has to be filed by December 31st, 2016. If you try to claim the credit on an original or even amended return after this date for 2015, they're going to disallow the credit. So you have to timely file the claim for the refundable credits. Now, another form used to calculate or really summarize the credit is this form called a Schedule CR that has both a refundable portion and the non-refundable portion. So let's take a look at a Schedule CR. So on this first side of Schedule CR are the non-refundable types. So let's zoom in to take a look at some of the wording here. So let's say that you have been working or have some type of income from another state, but because you're a Hawaii resident, you gotta report all of your income worldwide. And that would possibly cause a double taxation situation where you would pay income taxes to another state and to Hawaii. And usually in the state where you're a resident, assuming you're a Hawaii resident filing a Form N-11, Hawaii is going to allow you a credit for the taxes you pay to the other states. There are some limitations of this credit, so you have to take a look at the instructions to see those limitations. You have to do some calculations. For example, the credit you can claim here is not necessarily the taxes you pay to the other state, but possibly lower to the amount of Hawaii taxes on that double taxed income. Okay, so you have to take a look at those instructions here. Some of the other credits are basically business related. Let's see if we can find a common one here. So here is the one that's becoming popular, has been popular for the past few years. The photovoltaic and maybe solar credit. And in the past few years, it's been very popular. Maybe going to be less popular in future years because of the change to the so-called net metering benefit. But there is an election where the credit can be refundable for lower income taxpayers. They can choose to make it refundable, at least a portion to be refundable. Now, most taxpayers would treat this credit as non-refundable. Here first calculated and reported on this form N342. On the back side of this Schedule CR is the this front page is the non-refundable. On the back side of this form is the non-refundable credits from Schedule CR. Let's see. Here's that matching PV and solar credit. And again, most of the others are business related. Here's a common business one. So if you purchase a depreciable asset during the year, you know that you cannot deduct it, or under a Section 179, you could deduct it. That's something we learned in our Chapter 6. But in Hawaii, maybe the best thing to do is to claim this credit for those depreciable assets, which allows you to get back as a credit 4%, which is basically the excise tax you paid on those purchases. Now, you're not going to deduct it or depreciate it, but better yet, you get it back as a credit. Now, there's some rules in terms of now limiting how you depreciate the balance of the costs here on this N312 form to claim the credit. Okay, so let's go back again to the N-11. So refundable type here, non-refundable coming from Schedule CR we saw. And otherwise the credits are much different than the federal. The only one that's similar is probably that dependent care, this one right here, line 30, that's first calculated on Schedule X. If you have questions, go ahead and email me. This is